We're here in front of the impressive Bank of England headquarters, indeed the first central bank of its kind in the world.
In the past few months, the occupants of that building behind us have been gripped by a global credit crisis that's spiraling further and further out of control. At the current pace of events, we have the world's largest banks, albeit one by one, revealing losses worth billions of pounds.
Confidence is low in the credit market as well as with consumer confidence, and with the worst of it yet to come, the uneasiness amongst bankers, governments and the general public alike is growing more and more visible. Industry as well as private individuals are engulfed with debt. The average Briton today owes £30,000 as well as the net debt of the nation passing the £1 trillion threshold.
Despite the seeming locality of this problem to the US and Britain, its wider reverberations are yet to be felt throughout the world, with more worrying figures set to come in.
More importantly, the scope of this issue, which is undoubtedly linked with the consumerist attitudes of the people, will have to be looked at very carefully. Other pressures on the economy, namely climate change and an ongoing energy shortage, are exacerbating the situation to a point where capitalism, as a feasible model of development for the world, will itself have to be called into question.
In Britain, this was spelt out in the Stern Report, which was released several months ago. As dramatic as its conclusions sound, other risk analyst specialists, including insurance companies, have been warning of a situation which is reminiscent of the Great Depression of the 1930s and the two world wars put together.
Let's examine the monetary system in a little more detail to find the roots of the problem. One of the major services provided by the high street banks and the central banks, of course, is to lend money. However, with fractional reserve banking, they don't so much lend money, but invent it from thin air. Consider two individuals, A and B. A deposits £1 in a bank. On the back of this, the bank is allowed to create £1, or as is the case now with fractional reserve banking rules, more than 10 times the amount to lend to B, charging B interest. But the bank does not lend A's pound to B as is commonly assumed. That remains intact. Now for the really clever part. When B repays the pound loan, the pound which the bank brought into existence out of nothing, the bank keeps plus whatever interest B had to pay. Some argue that since debt and the interest on the debt can only be paid in the same form of money, the total debt, principal plus interest, can never be paid unless more money is created through the same process. For example, if £100 is created and loaned into the economy at 10% per year, at the end of the year £110 will be needed to pay the loan and extinguish the debt. However, since the additional £10 does not yet exist, it must be borrowed, leading to the cycle of ever-growing debt we see today. This is precisely why talk of paying the national debt without radical reforms in our monetary system is simply useless. There is wide grassroots support for a money system that has neutral value, that doesn't encourage greed and fear of scarcity, but instead has altruistic, community-spirited side effects. One of its more prominent proponents, Congressman and US presidential candidate Ron Paul, is running his campaign on the back of this kind of sentiment, with his proposals to go back to the gold standard being received with a great deal of enthusiasm. In fact, his campaign has been a runaway success. On the fundraising front, he's broken all records, raising an astonishing $19 million in this fourth quarter, without the help of big corporations and major channels. That's more than all of the Republican candidates put together. With similar proposals being discussed in New Zealand and actually operating in Austria, it's not long before the rest of the world takes note.
This is Koshin Garanet, reporting from London.